This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The war in the Middle East is literally a fluid situation. Oil prices are the needle mover right now for the global economy, virtually all asset classes, and of course, military engagement itself. Up next, there's no crystal ball, but let's frame the backdrop, read through the headlines, and think about what to expect going forward. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. There's a lot to contend with right now. I spoke a couple weeks ago about AI disruption and how it's wreaking havoc across the tech landscape, particularly in software. More recently, the private credit, I'll never say it was a bubble, but the private credit markets are really coming under a lot of pressure with the idea that maybe some bad loans were made to software companies. That is rippling throughout the financial sector. Many of the big banks gave loans to these private credit firms so that they could make these investments. So financials, particularly banks, many of them are down double-digit percentage just in the last few weeks. So there's a lot to contend with. But far and away, the biggest needle mover right now is, of course, the Middle East war and oil prices specifically. That's why I say it's literally a fluid situation, because oil and movements in oil are directly impacting in real time virtually every asset class. Stocks, of course, commodity prices, and the bond market. Okay, the bond market has moved significantly just over the course of the last couple of weeks. Investors have been whiplashed because a lot of the moves that we're seeing in these asset classes are completely the opposite, 180 degrees from the moves that we were seeing as recently as 3 weeks ago. So I know Chase, my colleague here, Chase Hinderstein, covered some of this last week. I really want to, no pun intended, drill down on that a little bit more today because, again, it's a major influence. I would also ask you for a bit of a hall pass. I fully concede that anything I say today may have a limited shelf life, may not age well, because this is a headline-driven market. Trump could come out with something, Iran could come out with something that could change the direction pretty quickly. So take all of this with a bit of a grain of salt, but I still think it's important to frame the backdrop so you have some perspective. As I mentioned at the top, read through the headlines and then can think about what to expect going forward. In the meantime, the S&P 500 has actually been one of the least volatile asset classes. You know, Europe, Asian markets, I'll talk about this a little bit more in a minute, they have been more volatile over the course of the last couple of weeks. A lot of those economies are much more exposed and reliant on oil coming and natural gas, for that matter, coming out of the Middle East. But the S&P has been volatile for sure, not only at the index level, but also within the market from sector to sector. We're pulled back in the neighborhood of about 5%. Which is the first 5% pullback since November. Remember, as I've said 1,000 times on this podcast and on the radio before that, these are the fleas that come with the dog. 5 to 6% corrections generally happen about 3 to 4 times a year on average. And by the way, according to FactSet, this is the 32nd pullback of greater than 5% since the March of 2009 low. So circumstances are always different, of course, but the fleas tend to be the same. The fact that the markets can't have these types of corrections or sell-offs for whatever reason. In fact, in 94% of years since 1928, we've had at least a 5% correction or more. Okay, so again, that's according to FactSet. Kind of in the present day, I'm going to talk about oil a little bit more specifically in a minute, but I will say, we're kind of in a new era the last few years, right? Where major asset classes now trade like meme stocks. I mean, we saw that with silver, right? Silver was down over 35% in one day a few weeks ago. We've seen it certainly with the stock market, but now we're seeing it with oil prices. It's sort of the gamification of everything. I read a piece on MarketWatch.com talking about how retail investors have come into oil ETFs in a big way, both on the long side and on the short side. And a lot of the frenetic activity in oil is being influenced by that, which of course also influences the spot prices themselves. So I'm not really making a point here other than to say that expect more volatility in asset classes that generally don't move this violently than maybe you were used to 5 or 10 years ago, which means it's extra important to be disciplined, to not overreact to daily swings or intra-daily swings in some of these things. I would say, though, the prognosis going forward is maybe not as difficult as you might think. And again, I'll get to this more in a minute. Generally, when you see big spikes in volatility like this, it augurs for actually higher markets down the road. I was reading a piece from FactSet. We saw about a 50% increase in the VIX, which is a widely followed kind of measure of market volatility. Over the last 80 years, when you've seen that, stocks have tended to bounce back with above average returns over the next 6 and 12 months. Doesn't mean it always happens, but that's been the historical track record. I did just want to, before I get into some of the specifics of the current situation, I did want to just kind of hit on some elements or some things to think about when we get periods of uncertainty like this, economic uncertainty, market uncertainty. The folks up at Ritzel Asset Management wrote a nice piece on this the other day. I think, one of the biggest takeaways from this, and I've talked about this a lot, is the biggest risk is rarely the one that everyone is planning for. Remember, I did a podcast earlier this year entitled Gray Swans. So those are not things that come completely out of left field, like maybe COVID, for example. But gray swans are things that maybe we thought could happen potentially, but we assigned a very small percentage odds of that. And clearly, the private credit volatility, Iran, these are things that we may have thought about, but they weren't in anyone's base case. Now they've emerged. There was a really good piece that I actually kept in my desk the reason I've kept it is to make a point. It was an Economist cover story back in November of 2019 with forecasts from experts about what might transpire in 2020. And they talked about things like a contentious presidential election, Brexit, U.S.-China relations, those types of things. But guess what they didn't talk about? COVID. No mention of COVID, right? So that was the black swan. But they also didn't talk about a lot of the gray swans that eventually hit the pond, right? They didn't predict oil prices eventually turning negative, supply chain shocks, fastest stock market crash and recovery in history, strongest labor market in a generation, 9% inflation that would eventually lead to a recession, AI saving the economy with the release of ChatGPT, which was sort of the catalyst for the market to come out of those 2022 doldrums. They didn't talk about any of those things. So it's not that the Economist was wrong. It's just that some of the really big market-moving events, both good and bad, were not front and center in everyone's attention. So what's the obvious takeaway? The obvious takeaway is if everyone is saying something, it's probably already priced in. Okay? It's probably already known. So, if you're parroting out the same kind of risk factors that everyone else is parroting out, market already understands that and is probably already moving on from that. So that's one takeaway. The other takeaway is, strong opinions loosely held. We see a lot of that these days, right? Very strong opinions loosely held, meaning that the media in particular will have conviction in a certain narrative, but then switch that conviction on a dime, right? Look at AI. Just a few months ago, AI was infallible, right? It was a narrative that couldn't fail. Now it's, AI, obviously the return on investment's not going to be there. Obviously these companies are overspending, right? The narrative has shifted 180 degrees. Don't be surprised if that narrative shifts in a different direction 6 months from now. What have we also learned? Discipline matters more than optimization. Optimization basically means, like that Carly Simon line, right? You're where you should be all the time. It implies that you should be in a portfolio that whatever's working at the time, you're well correlated to that. In reality, that is a very difficult game to play. And again, we'll talk about this a little bit more in the next few minutes. But what is doing well versus what's doing poorly has shifted violently multiple times just in the past 6 months. Trying to be on the right horse, trying to catch the momentum, I think is much less important than just being disciplined. There will be parts of your portfolio right now that aren't doing well. If you own banks, if you own tech, you're not doing well right now. But if you own maybe some other things, right, oil, other areas, you are doing well. It could shift back 3 or 4 weeks from now. Don't worry about being on the right horse all the time. Worry about being disciplined, keeping some portfolio balance. And this is kind of obvious, but focus on what you can control, right? I know it's scary to admit your hands are not on the steering wheel, but an illusion of control does you no good. And the last thing I will say, and I've said this a lot, timing the market won't help, right? The temptation to time the market grows, I think, when you had this type of volatility, right? This idea that you can kind of get out and get back in. Well, I read a good piece from Allie Jane Ayers saying that buying the dip is for losers. That was the name of her article. And she had a great line, right? She said, waiting for the right time. If you're doing that, you've got to ask yourself, what's the catalyst? What's the catalyst to reposition? Is it going to be when there's sort of an all clear here in the Middle East? Well, I don't know if that's ever going to happen. My guess is the best time to get back in if you're trying to time the market is when the news is going to be the worst. I remember the famous money manager, John Templeton, said, when it's really time to buy, you won't want to. And that's the point that kind of Miss Ayers is making. And her line is this: if you can't answer what the signal will be to get back in the market, you don't have a plan, you just have anxiety. I love that line. Okay. All right, I'll leave it there. Let's talk some specifics. But again, whenever you have this type of market volatility, I think it's always a good opportunity to take stock, to look in the mirror. Are you letting your emotions, your anxieties, the headlines, outside influences mess with your discipline? Just think about that. All right, so the oil markets, of course, continue to be volatile. The week before last, oil had a 36% spike. That was the single largest weekly percentage increase ever recorded. Some of that specifically, of course, has to do with the fact of where the conflict was, affecting specifically the Straits of Hormuz, through which about 20% of the world's oil production flows through. That's part of it. But also part of it is what I said earlier, the gamification of the markets. The fact that hedge funds, retail investors, trading algorithms are creating bigger moves in major asset classes than maybe we were used to a few years ago. But regardless, it is what it is. Oil prices up dramatically. And by the way, this is according to FactSet, this was a 6 sigma event. If you're a statistics person, that means this is only supposed to occur about every 4 million years. Okay, that's what we're talking about here. So what does this mean? Well, let's kind of look at it a little bit, not only the situation there, but also sort of some of the economic ripples to this. We know that over the past 3 years, falling energy prices have been helping to push the U.S. inflation rate lower. But of course, that tailwind is now a headwind, right? Gas prices have moved up on average to about $3.60 to $3.70 a gallon. Here locally in Northern Virginia, I've seen over $4. I saw $4.50 at one place on Leesburg Pike. That's an increase to their highest level since June of 2024. I think the issue is and I'm not going to get into politics here, but it's getting a little bit tricky to see what the off-ramp is, right? Because a lot of the ideas, the measures that have been floated, escorting ships, paying for tanker insurance, lifting Russia's sanctions, releasing oil from the strategic reserves, they're a patch, but they don't really address the problem. The problem is you've got to get oil flowing through that channel, essentially, that Strait of Hormuz. To wit, the International Energy Agency plans to release a record amount of oil from strategic reserves. Oil prices are up over 10% since that was announced. over 10%. So the markets are basically saying either it ain't enough or it's just not going to work at all. By the way, the amount that they're releasing, which is, I think it's like 400 million barrels in aggregate across all the countries, sounds like a lot, but according to MarketWatch, that's only about 16 days of volume. I heard someone else say 30 days. So somewhere between 15 and 30 days probably worth of volume. So again, it's a patch. It's a patch. And as I mentioned, it hasn't worked so far in terms of mitigating the rise in oil prices. Remember, we've been down this road before, though, right? When Ukraine-Russia war broke out, oil spiked to $130 a barrel. And yes, it came off of that, right? It was only up at that level for a relatively short period of time, but it took months for oil prices to retreat to prior levels. So we're going to have to deal with this for a while, even if we can get some sort of resolution. I don't know what that looks like, but even if we get some sort of resolution, we're going to have to contend with, I would think, at the very least, significant volatility in oil prices, but maybe elevated oil prices. Remember, there's all kinds of other variables that we haven't talked about. The remnants of Iran's regime or factions that Tehran cannot control, right? Even in the event of a ceasefire, they could continue to, wreak havoc in Hormuz with cheap drones for weeks or months, right? So I don't know that it's going to be as clear-cut as people are hoping for. Anyway, as far as gas goes specifically, gas is a really interesting kind of thing to focus on because I don't know if democratic is the right word, but it's something that everybody can see, right? It doesn't matter if you're rich, if you're poor, if you're black or you're white, red state, blue state. Everyone who's out and about on a highway, driving around, dropping their kids off at school several times a day can see what the price of gas is, at the pump at the local gas station. It is front and center for everyone and tends to be a really significant needle mover in terms of consumer spending, consumer confidence, and political outlook, right? And what have we seen? We've seen gas prices, go up significantly. I looked at Polymarkets. That's the kind of the betting site where you can see in real time what the odds are of certain things happening. Currently, as of when I did this research on Thursday, there's about a 42% chance that gas goes over $5 a gallon, which would be the highest level ever in U.S. history. So hopefully that doesn't happen, but that's kind of what's out there. So the whole sort of affordability narrative is challenging for Trump and his administration, right? Because you have gas up, and then it's not just gas, right? Food prices, I think, are vulnerable here too. A lot of people don't know this. It's not as well publicized, but it's also a pretty big choke point, the Straits of Hormuz, for fertilizer production and fertilizer delivery to the rest of the world. Urea prices, which is a key ingredient of fertilizers, up over 30% just in the past 2 weeks. Okay, just over 30%. And I read from Bank of America that crop yields are tightly correlated with increasing fertilizer consumption. So don't want to get too much into the weeds on fertilizer, but I think the bottom line is if this continues, and again, it's a question of duration, right? I mean, if it's over tomorrow, maybe none of this matters. But if this persists for weeks, months, you have to believe that food prices will be up across the globe. And then just to throw a little bit more sand in the gears, it's also a particularly important choke point for not only natural gas, particularly from Qatar, but also for helium, which is a byproduct of natural gas production. Both of those things are essential to the production of microchips, semiconductors. South Korea government has noted this. That's one of the reasons why the South Korean stock markets have been down over 20%. So, again, I don't want to get too much into the economic weeds here today because, again, it's a question of duration and magnitude. But I will say that all those things combined certainly have the potential to add to inflation. Goldman Sachs said this week that for every 10% increase in crude prices, that's roughly, by their math, about 0.2% in headline inflation. And we've had, 30 to 40% increase. So, that could add as much as 0.7 to 0.8% to headline inflation. We'll see. Luckily, by the same analysis, and Apollo came out and said something similar, they don't think that will have a huge follow-through on GDP. They think maybe 0.1 to 0.2% contraction in GDP as a result. But certainly it puts pressure on the Fed to not, cut rates right? They have to be careful. If you have inflation coming through oil and food prices and semiconductor prices, it makes it a lot harder for them to cut rates. And you've seen that in the Treasury market. Before this broke out, the 10-year Treasury had gone down to 3.9%. As of this recording, we're up around 4.25%. So that's what has also made this challenging is some of the traditional safe havens like treasuries. Treasuries often rally in times of geopolitical conflict, but not when oil and inflation is involved. So the bond market, bonds have held up a bit better than stocks, but not much better. Bonds have not really helped much. Again, this is in the short term. The long term, bonds, I think, will be more stable than stock prices, particularly with higher yields today than what you were getting 3-4 years ago. But in the here and now, mid to late March, bonds have not helped your short-term returns. And of course, you've started to hear the stagflation narrative, right? The idea of inflation without a lot of economic growth. I personally would look at stagflation with a very small s. I'm not in that camp. If you go back to the 70s, much different type of conditions than we have today. Back then, higher prices led to wage increases, for example, significant labor cost inflation. I think the odds of that are virtually zero in these times, right? With AI disruption, with the job market, without a lot of new jobs being created right now. So I would fade the stagflation narrative, but it is something that is coming into the sort of common wisdom, the headline writing. So just be aware of it. Okay, so again, I didn't want to get too much into economics because I'm not sure it helps you as an investor, but I did want to frame the landscape because what we're seeing here is not just, well, let me rephrase. There are significant ripple effects to what's going on, and the longer this goes on, the longer it's going to feed into the direction of certainly the stock market, because a lot of this will impact corporate earnings for some of the affected companies, right? So let's shift gears a little bit. Let's talk about the effects on the markets. We read a piece from Goldman Sachs that looked at the history of geopolitical conflict and influence on the markets over the course of the last 50 years. And I read this in several places. I did some work on this. According to them, the average initial pullback from something like this, when I say something like this, I mean a war that isn't, many years in duration. So, they weren't talking about like Vietnam, for example, but other types of geopolitical events like the Ukraine-Russia breakout, for example. And again, they went back 50 years. Median S&P pullback was about 6%. And then they went on and went all the way back to the Cuban Missile Crisis. Again, they backed out the Vietnam War because, that went for a decade, right? But they looked at the Six-Day War, the Gulf War, 9/11, Iraq invasion, Brexit vote, COVID-19. So not just wars, but geopolitical events. And the only two that had negative one-year forward returns after those events were 9/11 and the Ukraine invasion, okay? But I would argue that there were a lot of other things going on beyond those two events, right? Of course, 9/11 came when we were about a year in to the dot-com meltdown, right? So we were already in recession well before 9/11 happened. And then, of course, with Ukraine, that's when the Fed hiked rates from basically 0 to 5%. I would say that was really the driver of negative performance, stock performance in 2022. So, again, the historical record suggests that these types of events do not have long-term effects on the market. And when I say long-term, I'm not even talking long-term. It's really less than a year. So don't think that what's happening in the last few weeks is a referendum on how the rest of this year and the first half of 2027 is going to go. What about oil specifically? Well, again, the folks up at Ritzold Asset Management kind of made an interesting point that ironically, maybe not ironically, but maybe not so intuitively, S&P 500 returns are actually higher than when oil is up than when oil is down, believe it or not. They went back to 1986 and found that when oil prices are elevated in a given year, markets return about 13.1% on average. And by markets, I'm saying the S&P 500. When oil prices are down, 11.3%. Now, again, maybe this doesn't make sense on the face of it, but if you think about it more, higher oil prices are often a sign of better economic demand, stronger economies, so maybe that makes some sense. Obviously, that's not really what we're dealing with today. Today, we're dealing with a geopolitical spike. But still, the historical record says don't necessarily assume that this has to lead to lower markets. As far as the markets themselves, the S&P 500 and the Dow and what's going on here, particularly in the U.S. markets, I talked a lot, and Chase has as well, about the major rotation, how the markets this year have looked completely different than last year. Of course, last year, at least up until early November, was completely dominated by AI and tech and to a large extent, U.S. growth stocks. The value sectors, energy, materials, utilities, to a lesser extent, financials and healthcare, were laggards for the most part. Now, obviously, there are exceptions on a case-by-case basis, but for the most part, they were laggards. Well, up until this Iran conflict, 180-degree shift, right? Energy was up big, materials were up big. Meanwhile, tech, consumer discretionary, financials, were all down, right? And as a result, you saw growth funds underperform value funds because growth funds tend to be dominated by tech. Meanwhile, things like energy have a bigger representation in the value indices. In fact, by my math, and also FactSet's math, this was one of the weakest relative return periods for tech ever exhibited going back 5 decades, with all 7 Magnificent 7 stocks down for the year. This is as of 2 weeks ago. But what was interesting about kind of January 1 through, early March, was this rotation has not been all that supported by fundamentals. So, for example, again, before Iran broke out, energy was up over 25%, I think. Energy sector was up over 25% since October. But forward earnings expectations have actually slipped over that time frame. Now, again, maybe earnings get rolled up a bit with some of this crisis, but you had a situation where valuation multiples and prices went up dramatically, but it was not supported by any improvement in earnings expectations. Industrials might be a better example because they're not benefiting, of course, as much from these higher oil prices. Industrial sector valuations went up over 20% in the last 3 months. But forward earnings growth multiples are still only calling for earnings growth in like the 4 to 5% range. I shouldn't say multiples. Earnings growth estimates in the 4 to 5% range. So I've made the argument that a lot of this was about some of those sectors being underweight, underloved, underfollowed, tech being overbelieved, over-concentrated in portfolios. Maybe that was more of a catalyst for the rotation, more so than some sort of dramatic fundamental improvement for some of the sectors that have been laggards, if that makes sense. I say all this because for 2 reasons. One is I've made the argument that don't be surprised if the narrative shifts back and goes the other direction, 6 months from now, right? I made the point 2 weeks ago that consumer staples are now more expensive than technology despite significantly lower growth rates, right? So don't be surprised if things shift back the other way. But the other thing is during this breakout here in the Middle East, a lot of the things that had done well are getting crushed. Industrial stocks, a lot of them getting crushed, right? Because their input costs are going to go up. Chemical companies, for example, a lot of these material stocks are getting crushed. A lot of the consumer discretionary names, airlines, some of the things, restaurants, some of the things that had improved with the expectation of, bigger tax refunds, stronger consumer spending. They've gotten crushed because of the perceived bite of higher fuel prices and gasoline prices. And ironically, the only sector that is positive for the month is technology, the one that was getting killed 3 weeks ago. The other thing I would say is the international markets, which had been significantly outperforming the U.S. over the course of the last 6 months, they've significantly underperformed. I mentioned the S&P's pulled back, in the 5-6% range. South Korea is down over 20%. Japanese Nikkei was down 7% in a day. Europe has significantly underperformed the S&P. Why? Because they have more exposure, more sensitivity to oil coming from that region. And of course, they're not as self-sufficient from an energy perspective as we are here in the U.S. So what's the point? The point is, don't try to catch the narrative du jour. Don't try to optimize your portfolio by being in all the right things at the right time. I think it's a fool's errand because you never know when it's going to rotate back the other way. I think that one of the questions will be, we've seen a lot of internal corrections, right? I mentioned at the top how banks have pulled back over 10%. We've certainly seen a lot of tech names pull back over 10%. Do we see a correction at the broad index level? Because, as some things have done poorly, other things have done well, right? And vice versa. But the overall S&P is only down 5 or 6% off its high. Do we get an overall market pullback that pulls down everything, 10, 15, 20%? That remains to be seen. But again, the lesson is keep your discipline, keep balance in your portfolio. Don't get overly sucked into what the headlines are saying you should be buying or selling at any given time. I think that's good advice. All right, I'm going to leave it there. Remember the caveat I said at the very top. Cut me some slack. Know that that the world can change on a dime with a Trump tweet or a headline out of Iran or an escalation in conflict or de-escalation in conflict. But I think the principles of what I'm talking about remain the same. Up next, I have a few more minutes. I want to change gears a little bit and let you know a few headlines I'm hearing from some of the top holdings in our portfolio. Back in a minute. AI stocks still dominate the market, but valuations are almost back to dot-com bubble levels. How should you balance participation with diversification? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. I want to transition a little bit, tell you a little bit about what I'm hearing from a few of our individual holdings. Remember, as always, if you're a client of ours, I think you can feel pretty comfortable that we've done our due diligence and feel that these are appropriate ideas for your particular situation. The names I'm talking about are names that we own in a lot of our portfolios and that I also own personally. So you can think about that as a conflict of interest. Also, if you're not a client, please make sure you do your own homework because we can't manage, through the podcast. Of course, we're most of the way through fourth quarter earnings reporting season, so I actually don't have a lot to share with you. Did just want to mention Costco briefly, symbol COST. They are a late reporter. And, by all accounts, pretty good quarter. They beat on the top line. They beat on the bottom line. I looked at the analysis from the analyst here at Raymond James, and he noted very healthy traffic, up 3.1% worldwide year over year. Very resilient ticket growth, meaning how much you spend when you go in there. That was up almost 4% year over year. And continued membership fee strength, up 14% year over year. They did note that a little bit of slippage on online members, but I think they kind of expected that. They have the in-person membership. They also have an online digital membership for people that actually don't go into the stores. Those tend to be less loyal customers, a little bit more likely to start and stop memberships. So they kind of expected that, but that was probably the only mild negative from the quarter. Their in-person customers who are actually going into the stores, those membership levels were up. And their executive membership, which is a higher level of service and a higher fee, that membership growth was also up better than expected. So everything tracked pretty well. I would also tell you, and we haven't seen it yet because, their quarterly results were reported before the Iran breakout. But remember, Costco sells gas, and even though they lose some money by offering cheaper gas, it tends to drive a significant amount of traffic to the stores when people come into to fill the pump at Costco's cheaper gas prices. They're generally going into the store too and buying a bunch of stuff. So I actually think this works in Costco's favor, what's going on. Bottom line is everything seems to be tracking there. I think the knock on Costco, and I've mentioned this multiple times, is they're not a cheap stock. They're trading at a pretty high multiple. But it's actually right in line now with their 3-year median. So the multiple has not expanded recently. Despite Costco being expensive, I still think they're a store of value in this type of environment. But be wary of the valuation. Know that there's not a huge margin of safety when you're trading over 40 times earnings. So that's what sort of Costco had to say. Uber had some interesting news that maybe impacts Amazon a bit recently as well. So Amazon had kind of for a while, a fledgling kind of autonomous vehicle business, but is making a much bigger commitment to it recently. And they just struck a deal with Uber, a multi-year partnership where Amazon's robo-taxis, autonomous vehicle taxis, will be available via Uber's, ride-hailing app. So they didn't disclose the specific economic terms of that deal, but I thought it was really good for both companies. I mean, what started as science fiction and kind of a hope and a dream is now a ubiquitous thing. Uber's platform is now in over 20 U.S. cities. This specific deal with Amazon, they're going to be launching in Las Vegas this summer, Los Angeles next year. I think it's really good for both companies. And Uber stock responded positively to that. Just a note on Amazon, by the way. Amazon came under fire recently, just like Microsoft did, for overspending. And I read, not overspending, but increasing their capital expenditures on AI. And people are wondering, hey, what's the return on investment going to be? And read a really good piece from Deutsche Bank about, what they saw with this big sort of increase in CapEx spending was not some sort of loss of discipline from management. It was really a pull forward of capital that would have been deployed in the cloud over many years. And they felt that the risk, both Amazon's management and Deutsche Bank felt that the risk of underinvesting was much, by a factor of 3 or 4, much greater than the risk of overinvesting. And remember, Amazon has spent the better part of the last 20 years watching Amazon Web Services demand signals and then converting that into spending plans. So I think Amazon has a really good handle on what they should be spending at any given time. Obviously, the risks of Amazon are just that. What's the return on investment going to be? Amazon's very confident in that, but we'll see how that plays out. And of course, they compete with Microsoft and others in that cloud storage space. Back to Uber, they're also in a competitive environment. So whenever Elon Musk comes out with something and Tesla looking to expand into a certain market, it tends to hurt Uber's stock price. But I think what Uber has done is to be sort of channel and platform agnostic. They're just trying to be the preferred kind of ride-hailing app, but then not being prejudicial in terms of who they're striking deals with. So they're striking deals with Waymo, Google's platform. They're striking deals with Amazon, as I mentioned, multiple different manufacturers. They're also trying to control their own charging supply. They're going to invest over $100 million in actually having their own charging stations. So they want to make it as necessary as possible for other companies to partner with them. So I think Uber is very interesting here. They were over $100 a share, within the last 6 months, now down into the low to mid-70s, one of the cheapest names in the S&P for a company of their growth rate at their size. Again, there are competitive risks for sure, but the valuation looks interesting. Last thing, again, as long as we're talking about Google and Amazon and Uber, Google, by the way, I just saw this. This is just a side note. YouTube, of course, which is part of the Alphabet, franchise, by revenue is now the largest media company in the world. More revenues than Disney's entertainment and sports category business. Think about that for a second. I doubt very few people could say that at a cocktail party that they knew that to be the case. Now, of course, YouTube doesn't keep all the money. They split a lot of their advertising revenues with the creators themselves. But still, the fact that YouTube is that big of a player now, and I would say is only in the second or third inning of their importance in the global economy, is really something. So think about that when you think about Alphabet. People think about the search business and their new Gemini AI platform. They don't think as much about Waymo, their autonomous driving robotaxi business, and they don't think as much about YouTube. Probably should. The parts are worth a lot more than the whole, I think, with the Google, even though, as mentioned with Amazon and Uber, they operate in a very competitive space. So anyway, just some things to think about. Those are not really research ideas. They're just kind of updates on some of our top holdings that I thought you might find interesting. All right, I hope that was helpful. As mentioned several times, it's a fluid situation in the Middle East, so we'll do our best to keep you informed with how we're seeing things. I believe Chase Henderson is back with you next week, and I know he'll be up to the task. As always, we wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.